Thank you for joining today's live product walkthrough and Q&A session. My name's Dan McCollum. I'm a customer success specialist here at Snap. And for today's session, I wanted to go over an example of a young couple planning for retirement and perhaps answering some questions that clients or yourself may have for them. So, for example, how long will your client's money last? How much can they spend without running out of money in retirement? And are your clients saving enough for retirement? So I'm going to hop over into Snap. So here you can see I'm on my client list. Uh, on this page, I have my clients hidden. If you go up here to this three little lines, you do have the options to show all your clients or hide all your clients. In this case, mine are hid. So I'll just search for the sample client that we'll be working on today by his last name. And here we are. So we're going to be working within Sam and Rebecca King. So I am going to go open that up and I'll head over to our scenario setup for these clients. Now, I won't go into a great detail on all the information within scenario setup, just highlighting some of the assumptions that I've made in the plan. However, if you're not familiar with scenario setup or you would like some more practice, I did record some sessions. So if you go over to our help center and we go to webinars, and then we go back into our product walkthrough and Q&A, you can see previous articles or webinars, sorry, that I've recorded and my team's recorded. So specifically, a focus on scenario setup is an option, a focus on the planning pages, and then also a focus on client reports, among other various topics. So if you have the time, please feel free to come in and watch those webinars and previous recordings over here. Okay, so we're back into scenario setup. So quickly, we're going over our client Sam King. I've entered his date of birth, the province of residence, and his spouse Rebecca, and her date of birth. Moving over to the Generals tab, moving along the navigation of scenario setup. So some general assumptions, of course, that we need to make is when we're going to start the plan. We're going to run it starting in 2025. As we approach the end of this year, maybe it makes sense to start the plan in 2026. And this is where you have the option to do so. Now we have the retirement age for Sam and Rebecca, 65 and 64, and we're running this projection from until 199. Now, these assumptions that we've made here, these are recommendations from FP Canada in regards to the inflation rates. So general inflation at 2.1 and then indexing CPP and OAS at 2.1. Typically, FP Canada does update these guidelines in April or May. So when we see those updates come, we will be sure to implement them within SNAP. In regards to rates of return, I have reduced my rates of return from the defaults, again, which are recommended by FP Canada. So I've reduced them to account for any management fees that I would charge or that the investment manager would charge on the funds. So on the various different equity classes, or sorry, uh, cash, fixed income, and equity. Okay, so just moving over now to expenses. Now, a lot of the times, and in this example, I don't know what Sam and Rebecca plan to spend in retirement. They're not sure entirely either. So you can leave this at 0, which I'll do in this case, and we'll talk more about that when we get over to the planning pages. In regards to additional expenses, so for example, if they were wanting to update their home and they needed a renovation, you can add that as an additional expense. If there's a reoccurring vacation expense, for example, you can also add that under the additional expenses. For now, I will leave that as is. They don't have any additional expenses. And I'll just move over now to incomes. So for Sam, and again, we want to just be sure we're on the right tabs. So in the darker blue indicates that we're on Sam's tab to enter his income. Also, it also states it here as well. So for him, we've included employment income of 120,000. The type is employment income. I did not index it. I'm going to lean a little bit more conservative and leave that running flat throughout the plan. It is taxable income, it's RSP eligible, and we're going to run this up until age 64 because his first full year of retirement is in when he turns 65. Now, if he did have a defined benefit pension plan, this is where you could come and enter that information in. In this case, Sam doesn't have one, so I will just leave that as is. And I'll tab over now to Rebecca. And you can see here I've included Rebecca's employment income. We're not indexing that, just like Sam's. It's employment, it's taxable, and it's RSP eligible, and that will end the year before her first full year of retirement. So I'm going to move over to assets. So for Rebecca, again, I've entered a few different accounts that she holds. One is a joint non-reg account. So you can label it as is, the value, the cost base of that non-reg portfolio. And we just want to make sure we're selecting the correct type of account that matches our description of the account. I've indicated that this is a joint account and I've applied the appropriate asset mix. So based on 30% fixed income, 70% equities, it comes out to a total rate of return based on those assumptions that I made on my generals tab. And I've also added an RSP, the appropriate asset mix, and a TFSA. Now down here under real assets, I've added their home, so 680,000. The cost for principal residence won't really apply since there's no capital gains tax, but I've included 680 here. I'm going to assume it appreciates at general inflation, the 2.1. The future purchase age, if the clients currently hold the home, you don't need to worry about filling this in. This is if they were going to purchase a home in the future. You would enter either the age at which they were going to purchase, or you can get specific and actually enter a specific date in this field. Future sale age, I'm going to leave this blank as well, just because I'm going to assume that they're going to hold on to this home through the life of the plan. It's a joint asset, and again, capital gains does not apply to the principal residence. And then I've done the same thing for Sam. So you can see that joint account now reflected on his assets as well. And then I did add an RSP and TFSA for him. And then you can see the home also reflected under his name as well. Now, under the financial assets, there are these subheadings. I'll quickly go through those, starting with TFSA. So the TFSA contribution room for 2025 will default to the annual maximum, which is 7,000. However, if you have the carry forward or unused TFSA contribution room from your client, whether it be on a Service Canada statement or NOA, you can update that amount here. And just like the RSP, you're able to update the unused contribution room of your client for the lifetime. But again, the default will be 18% of the income that we entered in this case for Sam, that it will default to up until the annual maximum. And a couple more items on this page would be if he did have a defined benefit pension plan and there was a pension adjustment which could be grabbed from the NOA, you can update that pension adjustment here. You can also base the minimum withdrawals on the age of the younger spouse. If you're trying to limit taxable income, you just have to select it here. And then the last thing is the conversion age. So by default, Snap will convert an RSP over to a RIF in the last year that it can, which is age 71, and then they would start taking income at age 72. However, if you want to bring in income sooner, so in this example, we have Sam wanting to start retirement at age 65. So we could enter age 64 here. It would convert over to a RIF, and then the income would start the following year at age 65. For now, we'll just leave it as is. Under the DCPP Lira, so they don't have a Lira account. However, it's very similar to the RIF window here. So it will allow you to convert that account at a different age. You can also specify the jurisdiction of that Lira account, whether it be federal or provincial. And then there is an unlocking feature where you could unlock, say, 50% of that Lira or LIF and move that into a RIF account. And that can all be done on this window here. We have the first home savings account information. So if that applies to your client, you have the fields to fill in here. And the last one I want to touch on is the employer matching. So if, for example, Sam's RSP was actually a group RSP, you do have the option of basing contributions from the employee and employer. based on income. So you would just select employment income. It would unlock these windows here, and you could specify a certain percentage that each the employer and employee is contributing to those accounts. For now, I'm going to leave that unselected. Okay, so hopping over now to our debts. I've included their mortgage, the balance, the interest rate, again, future start age. If this was going to be a future purchase and a future mortgage, you could fill in the age of the client and again, a specific date during that year. The repayment options, we're going to do a blend of interest and principal. It's going to be a monthly payment of $2,000. It is a joint expense. It's not tax deductible. If this was, for example, an investment property, we could select yes for that. And then the most important thing here is making sure we link the mortgage to the home. So when you add a new debt or mortgage, it will say not selected. So we just want to make sure we go in here and tie that mortgage to the home. So in the event, say we were to sell the home, and the asset is linked or the debt is linked, it will make sure that this balance is paid off using the proceeds of the sale of the home. If they're not linked, this will not be paid off. Now I'm just going to hop over into our government benefits. So for Sam, I'm assuming that he's going to receive 80% of the maximum for CPP. However, if you actually have the dollar amount, the client's provided that with for you, you can obviously update it in this field. And then you do have the option of changing the age at which they take the CPP benefit. We're going to leave it at 65 for Sam. And we're going to assume since he's been a resident of Canada all of his life, he will receive the max OAS benefit. And then one final note here is I prorated the first year of CPP. He would receive a partial benefit based on when he was born. So we don't want to reflect perhaps that he gets the full benefit if he was actually born halfway through the year. So we just want to prorate the first year in this example, and I've done that for OAS as well. And then for Rebecca, I've assumed 60% of the maximum. Again, I've prorated that. I've started her CPP in the first full year of retirement. And then for OAS, I'm assuming, again, she's receiving the maximum. I'm going to prorate that benefit as well. Now, we do have other features here like insurance, if the clients have RESPs and settings and some advanced options. I won't get into those today. Just for the sake of time, I do want to get over to the planning pages. So on the planning pages here, I think one of the first things that jumps out to us is these highlighted yellow columns here. So these indicate that these are overrides that I've input, so it's easy for me to notice. And right now, these are contributions into the RSP and TFSA. So I'm just going to clear these out and re-enter them just so I can demonstrate how to do that. So in this case, I'm going to clear the overrides. I'm going to copy them down to age 64, which is the age I have the contributions running until. I'm going to hit the check mark. You're going to notice this run scenario has gone from green to yellow or orange, indicating that the plan needs to be refreshed. So let's do that. Okay, so now you can see those RSP contributions have fallen off. And then to simply re-enter them, we just click on this first zero. We're going to put them back to 10,000. Again, I'm going to copy them down to 64, which is the last year he's working. I'll enter those in, and I will run that scenario. Awesome. So you can see here, those are now back into the plan. And we're going to leave the $7,000 of TFSA contribution in as well. So just moving over, again, we're on the individual planning page for Sam. So you can do an individual planning page for either spouse, and there is a combined view. So just staying on Sam's individual page for a little bit, moving through the first row here, there's this base expense of $60,936. So what is that? So what's happening here within SNAP is it's taking their employment income, Sam's employment income of 120, less his CPP and EI deductions, less his taxes payable for the year, the 24,000, and then less his contributions that he's making to the RSP and TFSA, and then his portion of the mortgage payment, his 50% portion of that payment. What is left over at the end of the year for Sam would be the 60,936, taking into consideration all those items. And at this point, Snap assumes that they're spending this on their lifestyle. Now, the other thing to notice is once cash flow management is turned on, and by default, it will start in the first year of retirement, which we indicated in our scenario setup generals tab. It will begin there. However, you can move the cash flow management to start at any given year by simply moving the button around on this page. For now, we're going to leave it at retirement. And if you want to read a little bit more about cash flow management, there's this great article. If you highlight this little green gear under CFM, there is an article here that explains exactly what is happening with cash flow management in the manual years and the automatic years. You also have the option of disabling cash flow management. By default, it will be enabled. And in this plan particularly, I'm going to leave it enabled. Okay, so you can see here the cash flow management starts at age 65. And what happens during cash flow management is either it's going to save any surplus cash that the client may have, or it's going to do the heavy lifting for you and take out what's required in order to meet their lifestyle expenses, their taxes, any debt payments, any premiums, insurance premiums, for example, that you have entered. So again, the cash flow management will do the heavy lifting for you. In this case, we have no expenses entered. We assumed $0 when we were setting this up. So if we move over, we see that he's starting to receive his government benefits. So there is a bit of a surplus cash because he has no expenses essentially except his mortgage payment. And you can see here it's being saved to the RSP account. So I'm under the financial assets with the various accounts. So the value, the contribution, the rate of return we're assuming. So again, if we go down here, we can see that a contribution is being made from that surplus to the RSP. So there is a default order in which surplus cash is dealt with within SNAP, and it is customizable, but the contributions would first go to an RSP. They would then, if the RSP, for example, was maxed out, or if it was in a RIF stage, so you can't contribute obviously to a RIF account, it would then want to put the money into the tax-free savings account. If the tax-free savings account was maxed out, it would then deposit this surplus into the non-reg. And I can show you the order of those contributions. So if we go up here and click on the little gear icon, and we select the first option, show the CFM order column for this scenario, a new column will appear, two new columns under financial assets, the CFM order. So going down to when, again, CFM starts, you can see the contribution order. So RSPs, tax-free savings, non-reg, which is exactly what is happening here with the surplus. If you wanted to change that, you absolutely can by clicking on this and changing the order to what you wish. So if you want that to go to the tax-free first, and then non-reg, then RSP, that's an option. You can do it in one given year, or you can copy down that order throughout the life of the plan. And just like contributions, once we have entered expenses, and I'll be able to illustrate this in a little bit, withdrawals will occur in this order. So it will first start pulling from non-reg monies, and then tax-free savings, and then finally RSP. But if you say, for example, you wanted to deplete RSPs first, you have the option to come in here. And again, perhaps we want to do RSPs, non-reg, and leave the tax-free savings money for last. And again, you can do that for 1 year, and you can do it for the life of the plan. For now, I'll just leave them at the defaults. And just quickly going over to Rebecca's page. So again, what's left over after Rebecca's income is taken into consideration? She's paid her CPP and total taxes. and her savings and her portion of the mortgage payment. What is left over for Rebecca is this 46,372, and that's assumed to be spent. If we go down to the cash flow management and move over, she does have a small surplus of cash. And again, based on that default order, it's being deposited into the RSP. So I'm going to hop over now into the combined planning pages. So this illustrates both of their accounts, all their income. So everything is combined on this page. And you're going to notice little arrows up here. So these can be expanded out. So right now we have their total income lumped in together. So if we click on this, it then breaks out each of their individual income. And if you hover over that name, you can see whose income that is. So if you're ever confused, you can do that. And just like for the financial assets, currently we have that joint non-reg. This is the combination of their two TFSAs and the combination of their two RSPs. However, if we expand that out, we then can now see them on an individual level. And again, hovering over the title of the account will give you exactly who account that belongs to. And this would be joint. Okay, so again, coming down to the cash flow management years, we have assumed $0 for expenses. Obviously not very realistic. A starting point in this plan is perhaps we assume that Sam and Rebecca would like to maintain their current level of spending. So if we go up to 2025, we can see what's left over at the end of the year between the two of them is this 107,308. So perhaps that's a good place to start. So I'm going to fill that in. And I'm going to copy that down for the life of the plan. And let's run the scenario and see what that looks like. Okay, so you can see now the 107 has stuck. So 107,000 in today's dollars. What they would actually be spending in 2043 would be the 155,542. We can move over, we can see their benefits. Again, we can expand this out to see CPP and OAS benefits. What I want to highlight here is you can now see from their joint non-registered account, they're starting to pull money, and that account is depleted in the next few years to make up for this lifestyle expense. So you can see that is depleted. And then the tax-free savings account withdrawals begin. Again, this is the default order for withdrawals right now. That can be fully customized, but we're just sticking with the default here. And then once those TFSAs have been depleted, RIF withdrawals have already started, but you can see now they are bumped up once the tax-free savings monies run out. So here and here, you can see the difference in withdrawals once the tax-free money is gone. If we continue down, you're going to notice that they run into this red block. So this is indicating a shortfall in the plan. So you can see the open account has no value. The RSP is completely depleted, and the tax-free accounts are completely depleted for each Rebecca and Sam. So what happens now is a cash balance starts to occur. So you can see under the net cash flow what they would be short in that given year. And then the net cash flow is added to the cash balance. So you can see essentially this is a loan building up over time. So by the end of the projection, this loan would be worth 2.7 million roughly to sustain $107,000 in spending. So this is obviously not ideal, not very realistic. So what a great feature in Snap is we can move over to our recommendations tab here at the top. So if I open this up, I'll touch on a few of these. I want to highlight the sustainable spending right now. So what sustainable spending will do is tell us exactly how much the clients can spend every single year and have their financial assets depleted to zero, but without running into any shortfalls. So if we calculate this, it might take a minute. So the answer is approximately 92,000, which is $15,000 less than what they ideally want to spend of 107. So before applying and running this, I always recommend that you make a copy of the plan uh, prior. So I'm going to make a copy by selecting it down there. I'm going to apply and run that. Now it will create a new copy and bring me into that new copy. And you can tell that by it's changed the title of the scenario. So base scenario, sustainable spending. So now you can see the 91,773 that was recommended has been input into the plan. And if we scroll down, you can see that there is no shortfall in the plan. And if we scroll over, you can see the tax-free savings, the non-reg is depleted. There's a small amount left over in the RSPs. And then all that's left over from that is their home, their real estate. So we've answered two questions. The first would be the base scenario, how long will my money last? Under the assumption they want to maintain the 107, which obviously we ran into a shortfall in that scenario. We now have answered the question, how much can I spend? What's the max I can spend? I want to run one more scenario. So I'm going to switch back into our base scenario, and there's a couple ways you can go about doing that. You can simply click on the client's name here at the top, and it'll get you to be able to go back into the base scenario. You can also go to these three little lines, switch scenario, and again, it would present you with the same window. So let's hop back in there. So now that we're back in here, we're in that shortfall position, but perhaps the client wants a couple different options. So if we go back into recommendations, we can calculate if Sam and Rebecca are adamant about spending this 107,000 in retirement, perhaps they need to delay the retirement age. So you can calculate that using the retirement age option. Okay, and so in this example, it's telling them they could retire at 69 and 68, which is 4 years later than what they currently want to retire at 65 and 64. But this would allow them to be able to start spending that $107,000 spending goal. So I won't apply and run that one. Let's talk about the required savings. So required savings will tell us how much money they would need to save in addition to what they're currently doing to their RSPs and TFSAs, what that additional amount is leading up to retirement every single year. So if we calculate that, so the answer here is roughly 21,000 of after-tax dollars would need to be saved every single year leading up to retirement. So let's see what that looks like in the plan. So again, I'm going to make a copy and I'm going to apply and run this recommendation. And here we are. So you can now see they are still retiring at 65 and 64 with the $107,000 of desired spending. However, now you can see in the non-reg portfolio, we have that required savings of 21,138 being deposited into that non-reg. At retirement, they start to withdraw from those accounts. And if we continue scrolling to the bottom here, you can see they're able to maintain that without running into a shortfall. The non-reg is depleted, the TFSAs are depleted. Again, there's a very small amount left over in the RIF account, and what is left over is the real estate. So that answers our third question, are we saving enough? In this particular case, no, these clients weren't, but we were able to identify what that additional amount they would need to save if they were in fact wanting to spend the desired 107. Okay, so I think that's what I wanted to go over today. If there are any questions, feel free to submit them in our Zoom chat here. There should be a Q&A box. If you do have questions and I don't get back to you during the session here. It's just wrapping up. I will be sure to follow up with you in an email or a phone call. I'm more than happy to do that. One last thing I would just want to leave you with is our help center. I can't emphasize it enough. It's a great resource. There's various topics here if you want to scroll through the topics, or if there's something specific that you are looking for, you can try searching for it, whether it be a step-by-step guide or a webinar or an article to learn more about it in Snap. And then again, our number up here, we're here 9 to 6, Monday to Friday, Eastern Standard Time. That's why our team is here. We're more than happy to help you out, whether it be review a plan or help you model something specific. And you also have the option to just send us a message here, and the team would be more than happy to follow up with you. But with that being said, again, I appreciate you joining, and yeah, I look forward to doing many more of these as the weeks progress. Have a great